Hey there. Well, I'm taking a break from the garden today to talk about a topic for digital agencies, the topic of client contracting. And I'm not a lawyer, so I'm not intending to talk about this from a legal perspective about what you should have in your contracts or not have in your contracts from a legal perspective, or how you should format or construct your contracts from a legal perspective. I would highly encourage you to be working with qualified attorneys to kind of get those general contracting terms set up for yourself. I'm talking about contracting from the economic standpoint of how you kind of do your contracting for best efficiencies in your business, and also from the standpoint of administrative burden, because there's some things that if you had endless time and resources that you would say, yeah, why not? Let's do it. But you have to always weigh the cost benefit of providing different kinds of opportunities or options for your customers or your clients. And I'll kind of try to talk more to what I mean by that, because in our work in kind of advising from a CFO capacity with digital agencies, one of the things that we see is many small and mid-sized businesses that are digital agencies are focused on serving kind of a small set of clientele, a high value client base, right? They have a limited number of clients. Each client is a high value. And in that scenario, what we've seen and what we think works well or works okay is having a customized set of engagements or customized project contracts where the terms of the contract are variable. And what I mean by variable terms is that the actual service delivery is highly customized, so it's very different for each client. The way in which the services are delivered, the timing of which the services are delivered is very customizable. The fees are very customizable and can vary widely how the fees are structured. And the payment terms, in terms of whether you get paid up front or paid throughout the contract or at the end of the contract, is very variable and depends on the client. And again, I think all of that kind of customization makes sense to me and makes sense in what I've seen with other digital agencies if you're serving a limited set of high value clients, because in that scenario, with a limited set, you can administer those contracts well. You can track them from an accounting standpoint. You can do the accounting for them correctly, and you can do what I would call WIP accounting for it, right? And it's not going to be too much of a burden because you have a limited set of contracts to do this for. The alternative, which I think can be problematic, is if that's not who you are as a digital agency. If as a digital agency, your business model is to do a high volume of a lower margin type of work, right? Which there's nothing wrong with that business model. Maybe you have a really good setup that allows you to crank out different kinds of content, or maybe website designs or website structures for clients just in a very slick and manufacturing-like process way, and you have a good business model for doing that, and you have a good sales machine for bringing the clients in for doing that. Nothing at all wrong with that. But what I do believe about that, and what we would advise a client in that situation, is that you shouldn't have variable terms to your contracts then, right? Your contracting terms should be more standardized. And the reason for that is because you're going to end up spending excised amounts in administrating your contracts, managing those contracts, trying to stay on schedule with payment terms, and ultimately doing the accounting for those contracts. The cost of all of that will be outsized compared to the revenue of your business, because there's kind of a typical amount of cost for any size of a digital agency. There's a typical kind of a budget that you would spend on accounting and administration and finance. And if you are causing yourself to do an unusual amount of administration for the revenue levels that you have by having a high volume of contracts with variable terms that aren't standardized, so you have to account for each contract in a different way, your accounting costs are just going to outstrip the benefits of whatever you're trying to achieve there with variable contracting in a high volume environment. So it may be obvious to you, but from an administrative standpoint, if you're doing high volume work, you want to be as standardized as possible, right? If you're doing low volume, high value, low volume work, then customization or differentiation can work just fine. In terms on the accounting side, what I'd like to raise is just some things that you should know about contracts if you're doing the accounting. So if you're in the accounting function for the digital agency, or maybe you're consulting for the digital agency, or maybe you're in the owner group who has to be involved in the accounting for the digital agency, or some other leader in the company that has to be involved in the accounting, this is for you in terms of considering questions that you should probably hone in on within your contracting, things that you would need to identify in order to get the accounting right for your contracts. And so the first category of questions or things that I would consider are the delivery of service issues. And so one question was, in your contract, can you determine or tell when performance obligations of that contract have been delivered? Is it clear in the contract when you as the digital agency will have satisfied your performance obligations? How will you know that you've satisfied your performance obligations? And another question is there, how many performance obligations are there? Is there only one? Like, you got to get this whole project done and get it to completion, or you just haven't accomplished anything of value? Is there only one performance obligation and perhaps it happens at the very end of completing the contract? Or are there multiple performance obligations? Are there different phases where you arguably or agreeably in your contract have actually contracted and agreed that you will have delivered value and that you will have satisfied performance obligations at various phases or milestones in the project? So if there are multiple performance obligations like that, identifying what they are would be important. On the fee side, what you need to look for in terms of fees in the contracting in order to do the accounting is, what is the fee? What is the total fee for this contract? And is there one fee? If there's multiple performance obligations, do you have one fee that is not obvious how it divides up among the performance obligations? Just one fee for the entire contract, but there's actually multiple projects or performance obligations in the contract? You're gonna have to think about how you would deal with that. How would you assign the fee for accounting purposes to the different projects or to the different performance obligations? Or maybe the contract helpfully actually has different fees assigned to the performance obligations. Then you just need to kind of do a little reasonableness audit. Does the contract's specification of fees for performance obligations actually match the economics of those performance obligations? In other words, it's possible that a company may just make some arbitrary assignments of fees to different phases of a project, but they don't, the way they're assigning fees doesn't necessarily line up with the value of those parts of the overall contract, and everyone just agreed to it because they were like, well, we're all going to get paid anyway, we trust each other, so that part doesn't matter so much. And then when you go back and do the accounting, you look at it and you're like, well, there's no way that this one phase is worth this amount. You have to do that kind of reasonableness check, because just because the contract says that's what that you pay at this phase doesn't necessarily mean that that's what that phase was worth, right? You have to get to the economic reality of what is the actual value of that performance obligation, how much of the overall fee should be allocable to that performance obligation. And there's also just questions about how the fee are structured, right? Are you charging your clients by the hour? Are you charging them a fixed fee for the entire contract? Is it based on some other metric? Like if websites or applications or some kind of, apps, that's what I'm thinking, have a certain amount of uptime or a certain amount of usage, then you get some percentage, or there's some kind of mathematical metric of actual performance of something like that then triggers how much money you get. I've seen all kinds of interesting deals like that, and so that's fine, but of course, to do the accounting, we have to know what that model is and understand it in order to account for it properly. And one of the other things that you have to look at in the contract to get the accounting right is, are there any penalties for lack of performance, right? So for example, is there like maybe a website uptime fee kind of penalty if the website or other kind of components don't have a certain amount of uptime, or if they don't perform in a certain way, maybe there's not a fee. Maybe your fees aren't directly metriced to their performance, but your penalties are, right? Like if you don't achieve certain expected performance with applications developed or websites developed or anything or other digital content developed, then perhaps you get a penalty. Maybe your fee gets curtailed by some amount, right? And so of course, knowing that ahead of time is going to be important for getting the accounting done. Your invoicing terms, which is not the same thing as your fees, right? It's you establish what the fees are in the contract, but then it's like, well, when do you get to invoice the client, right? And so are you invoicing the client up front? Are you invoicing the client throughout the project at certain milestones, or just ratably every month throughout the project? Are you invoicing the client at completion? And the invoicing terms are not the same thing as the payment terms, right? Because once there's one question is, when do you get to invoice the client, which you need to know for accounting, and that's going to be in the contract, right? But the other question is, once you invoice the client, how long does the client have to pay, right? How long does the client have before they are required to to pay you, right? So do you say, well, invoices are payable on presentation, or are you giving them credit terms like 30 days? You know, you issue the invoice and you say pay within 30 days or something like that, right? So of course that needs to be known, just like with any other company, that would need to be known in order to set up your AR modules and the accounts receivable process in your overall accounting process properly. Okay, well, that's it for talking about kind of contracting issues or questions that you kind of have to get to. I think in a future video, I'll kind of show you some ways, some tools that we use with digital agencies once you kind of know that information to kind of help the accounting process along. So that's it for now. I'm going to get back over here to doing some gardening today, and I will talk to you later. Take care.